Skeptical. Scroll through any social feed late at night, and you will find someone claiming you can build a six-figure empire from your bedroom with zero skills and $0. When a business model requires no specialized knowledge or capital to start, you are entering a market with millions of other people at the exact same time. This massive influx of competition guarantees an immediate race to the bottom on pricing. To identify what actually generates wealth, we have to ignore the lifestyle marketing and judge these models by four metrics: the upfront capital required, the net profit margin, the time to reach profitability, and the historical success rate. This chart plots invested capital against statistical success rate. Most ventures clump in the bottom left. Only a few elite models break top right. That red zone identifies low barrier entries as 0% margin traps, high-risk systems relying on volume you cannot reach. Building a successful company is an exercise in resource management. Your results depend on aligning your current liquid assets with a model that mathematically supports growth. We begin at the F tier with multi-level marketing. This model functions as a negative-sum structural trap, where your compensation depends on recruitment rather than product value. The math of recruitment hits a hard bottleneck very quickly. If every participant brings in 5 people, the number of recruits needed for the next layer exceeds the population of Earth in just 13 steps. This structure results in a success rate of less than 1%. Most participants lose their entire principal investment and finish with a 0% profit margin. The D tier contains physical drags like traditional restaurants and independent retail shops. These require heavy upfront capital, often $500,000 or more, to cover commercial leases, industrial equipment, and zoning compliance. Once operational, recurring costs like rent, staff payroll, and perishable inventory spoilage choke your net margins down to single digits. High overhead prevents the rapid capital velocity new entrepreneurs need to survive. This is why 80% of these physical models fail within 5 years. C-tier models utilize digital infrastructure to lower entry costs, but they suffer from extreme saturation. The primary examples are dropshipping and print-on-demand. You list products from overseas suppliers and rely entirely on paid social ads to capture traffic. You never actually handle the physical inventory. While startup costs are low, customer acquisition costs on ad networks are skyrocketing. This creates a ceiling where your net profit margin flatlines at 5 to 10%. If a product goes viral, automated bots will clone your landing page and creatives within 48 hours, obliterating your market share before you can scale. Ad-based novelty apps face a similar fate. Most free utility apps die with fewer than 1,000 downloads because they lack the sustained traffic volume needed to pay for their own hosting. Digital business models without built-in operational moats function as expensive data collection experiments for the advertising networks you pay to reach. The B tier represents the most reliable path from zero to scalable capital. This includes solo freelancing, consulting, and specialized trade services. In this tier, you trade technical skills directly for capital. Whether it is full-stack engineering or specialized electrical repair, you are selling a high-value solution to a specific corporate or local problem. Because you use your own specialized knowledge and existing hardware, entry costs are near zero, allowing solo operators to maintain net profit margins above 90%. To scale beyond your own time limits, you transition into the agency model. You build a brand and hire junior contractors to execute the work you've secured. Your profit margin will drop to 20 or 40% to cover your team's payroll, but your total revenue potential is no longer tied to your biological hours. Specialized labor is the mandatory stepping stone for founders who lack inherited capital but need to generate a cash baseline for larger ventures. At the absolute apex are S-tier assets, software as a service, and two-sided marketplaces. Software as a service operates on monthly recurring revenue. You engineer a software tool once and license access to it infinitely. The moment a user stops paying, the utility of the tool disappears. This model generates net margins of 70 to 90%. By removing physical fulfillment logistics, you decouple your income from the cost of manufacturing and shipping. Two-sided marketplaces like Uber or Airbnb focus on owning the digital connection rather than the service itself. These platforms own zero physical inventory. They simply command the central digital grid and extract a mandatory transactional tax from every connection made across the network. While the upside is massive, these systems require high development costs and years of capital injection to reach the critical mass of users needed to be profitable. S-tier monopolies represent the highest form of financial leverage, but attempting to build one without prior B-tier cash flow or venture backing is statistically doomed. Corporate theory is only valuable if it leads to a personal execution plan. Your path depends strictly on your current bank account and available time. Your trajectory splits into two paths based on a single variable, whether you currently command more or less than $100,000 in liquid capital. If you have less than $100,000 and are locked into a high-demand job, you follow the passive pipeline. You cannot afford to risk your limited savings on a high-overhead physical startup. Your directive is to funnel every dollar of excess salary into low-cost index funds. This guarantees slow, hands-off compounding without the risk of operational failure. For those with low capital but hundreds of uncompensated hours to invest, we utilize the time leverage track. You spend your time mastering a B-tier specialized skill to generate immediate cash flow. You then take that capital and inject it into building a scalable S-tier digital asset. Long-term financial autonomy requires a relentless alignment between your personal resource constraints and the mathematical business framework most likely to scale.